Hi everybody, this is Alex Deploy from Expert Forex. Previously this week I produced a video showing a trading technique using envelopes and the RSI to identify double in a day trades. I've since gone back into this week's trading and had a look at how one would have fared if one had traded that particular technique. And in fact, this is a live trading account with the trades in them, and on the screen you'll actually see the trades marked on the trading chart. This is a facility that MT4 allows you to do, is you can actually pull your trades onto the chart and see the historical trades, and I have done that. I've pulled the historical trades onto the chart, so we can have a good look at this technique that we spoke about earlier this week. By the way, if you want to get the settings and the setup for this particular technique, it is available in the previous video. A description or a link to that particular video will be posted along in the YouTube posting and on the website page where this video will be posted, so you should be able to get that link. So I'm not going to repeat the information from that video, but essentially what you do is you set up the RSI indicator and you set up a envelope lines, and what the envelope lines basically capture 95% of the price movement. And what you would do is, once the price has touched the upper or the lower line, you would then trade based on the RSI setting. Now I'm going to do a slight deviation on what we did earlier this week. I'm going to say this is a very simple technique. Just listen very carefully. If the price touches the upper or the lower envelope line, you immediately look to see if the RSI is either overbought or oversold. If it is not overbought or oversold, you do not trade. You only trade if the RSI is overbought or oversold. So here we go. So this was the start of Monday, sort of early Asian session. The price touched the upper envelope. A trade was made. It was stopped out. You can see the follow on. It was actually stopped out over there. So there was a stop out trade. Boom, failure. But that's also trading the Asian markets, not the greatest idea. Anyway, a further trade was then made because the price was still touching that upper envelope and it was still overbought. So a further trade was made, and it was in fact topped up. There's the entry, there's the top up, but stopped out on a retracement. So we stopped trading there because the price stopped touching the upper envelope, and we started with a loss and a stop out for the week. Then along it came, and there was the next touch. That touch, in fact, was a break-even stop out. It actually stopped itself out on a break-even basis. Then another entry was made when it went below the red line, the lower envelope line. Another entry was made, and again that was stopped out at that point. And then a further entry was made as a result of that stop there. It wasn't made at the point of the stop. It was done a little bit late, but also stopped out. So our record so far is 1, 2, 3, 4 stop outs and a loss. Not really great. Anyway, so we move on. Oops, there it touches the upper, but then you look down and you see, oh, it's in the middle of nowhere. We can't trade. It's not in an overbought or oversold situation. So you move on, and there it touches the upper line again. There you can see the entry occurred right there. It was in an overbought environment, and this was in fact a successful double in a day trade. So there's the initial trade, there's the first top up, there's the second top up, and that is the cash in of all three the transactions. So far net we've got one failure and one successful double in a day trade, and when you have in general you can get about between 15 and 20 unsuccessful trades to every one, and you'll make a lot of money. So we're doing pretty well at this stage. One loss and one profit. So on we go, on we go. The times that it does touch again is in no man's land. Don't trade there. You wait until the RSI is overbought and the price is violating the envelope lines. Okay, so there's a violation in an oversold situation. It's successful. It actually gets topped up again, so that was quite a successful deal, but the retracement stopped it out, and you can see, unfortunately, that deal came to no avail. Another break-even transaction. So those upper touches are in no man's land here, so we don't take them. There's one. Okay, so it comes down, touches the lower level. It is in an oversold environment. We can enter it, and in this case we do. And there's the initial trade. There's the top up. There's the second top up, and there is the cash in of all those three deals. So in this short example, you can now see how the double in a day technique works. It is a bit frustrating. You do have a lot of break-even top outs, stop outs. You do have a few stop outs at losses, but if you trade responsibly and trade with a good technique, you can do pretty well with this double in a day technique. So we've got two double in a day trades, a whole lot of break-even stop outs, and one loss. So from me, Alex Deploy, I hope you've enjoyed this video. Please have a look at my previous video to get an idea of this trading technique. It's not exactly as I stated in that one. Here we are only looking at a touch of the envelope and a confirmation that it is overbought or oversold. Slight variation on that particular technique. Again from me, Alex Deploy, cheerio.